Welcome back to Investing Talk Podcast.
Today we're looking at Rocket Lab.
Yeah.
And they've really made a strategic shift in their identity. They're moving away from just being a pure launch provider
Right.
to becoming this comprehensive space systems provider. And that evolution is just pivotal in the small satellite market right now.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis. To really understand why this shift matters, I think we have to start with the fundamentals. And that story really begins with a staggering revenue explosion.
And you know, explosion isn't really hyperbole here. We are not talking about small little incremental gains. The revenue has, well, it's more than doubled over just the last 2.5 years.
Exactly.
Their TTM revenue, that's trailing 12 months for anyone new, has now hit over $554 million.
And you can see that acceleration so clearly in the numbers. I mean, if you look at last year, 2024, revenue was $436 million. That's a massive 78% year-over-year increase.
Wow.
And then more recently, Q3 2025, it came in strong at $155 million, still up 48% year-over-year.
What strikes me, though, is the quality of that revenue. I mean, the growth isn't just because they're launching more rockets, it's because they're getting into those higher margin parts of the business.
Exactly, the space systems division.
And that should lead straight to better efficiency. You know, moving from an R&D heavy startup to a real manufacturer that has to show up in the margins, what are they telling us?
They're telling us the whole business model is maturing and fast.
Yeah.
That vertical integration strategy is paying off big time. You can see this huge shift. If you go back to 2020, gross margins were deeply negative.
Like how negative?
Around negative 34%. Now fast forward to Q3 2025, and those margins have swung all the way up to a positive 34%.
A 68-point swing. That's extraordinary. That means they've gone from literally losing money on every service to making a substantial profit. That's a totally different company.
It is, and the momentum is still there. Their Q4 2025 guidance is projecting GAAP gross margins.
That's the standardized accounting measure.
Right, to move even higher, into the 37% to 39% range. And that sustained growth is exactly what analysts want to see, especially when they start thinking about their next-gen rocket, Neutron.
Okay, so what are the analysts expecting for the immediate future? Where do they see revenue going next?
Well, the forecasts are pretty optimistic. They point to continued acceleration, mostly fueled by all these defense contracts. So Q1 2026 revenue is projected around $105 million.
Okay.
But then it's expected to accelerate pretty significantly to about $144.5 million in later periods. And that's all supported by this big backlog of contracts finally turning into real money.
Which brings us to their competitive moat. I mean, if they're not just a bus service to orbit anymore, what is their real advantage? We hear vertical integration thrown around all the time, but what does that actually mean for locking out competitors?
Well, think of it this way. Most space companies do one thing. They're a launch provider, or they build satellites, or they develop the sensors.
Right, they specialize.
Rocket Lab has basically pulled all three into one company. They have the launch services Electron now, and soon Neutron. They manufacture the satellite platforms themselves, like the Lightning platform. And they even provide the critical payload, like their Phoenix infrared sensors.
So you're not just buying a launch, you're buying the whole mission end to end. They control every single piece of it.
Precisely. By controlling that entire stack, from the sensor to the satellite bus it sits on, to the rocket that gets it to orbit, they capture the whole profit margin.
And that must create really high switching costs for, say, a government client.
Yeah, huge switching costs and massive IP barriers. It instantly positions them as a defense prime contractor, putting them up against the really big established names. And the proof of that pivot is, well, it's that huge U.S. Space Development Agency contract, the SDA contract.
That was the game changer, wasn't it?
It absolutely was. The big one was the $816 million contract for 18 missile warning and tracking satellites.
And this is part of the Tranche 3 tracking layer, which... For our listeners, that's basically the backbone of the U.S. effort to track things like hypersonic missiles.
Yes. So this isn't just some commercial deal. It puts Rocket Lab right at the heart of the national security apparatus.
So why them? Why did they get chosen for something so critical?
A few reasons. First, the system they offered was very cost-effective. Second, they have that proven launch reliability with Electron. And third, this $816 million, it's actually part of over $1.3 billion in total SBA awards they've won.
I see.
So they've cemented their role in this missile tracking niche, which guarantees they benefit from defense budget tailwinds for, years to come.
And that gives them incredible revenue visibility. I think they're sitting on a total backlog of about $1.1 billion.
That's right, and the conversion rate on that is really strong. About 57% of that billion is expected to become revenue within the next 12 months.
That's a level of predictability that a pure play launch company just doesn't have.
Not at all. And it's all backed up by that reliability you mentioned. The Electron rocket has a perfect 100% success rate across 21 missions in a row. For a defense customer, that kind of certainty is, well, it's everything.
Okay, so we've covered the bull case pretty thoroughly. The growth, the margins, that huge SDA contract. Now we have to do the reality check. Investing in a hyper-growth space company comes with real risks. And despite that great revenue, the bottom line is still negative, isn't it?
That is the essential reality check, yes. Net income is still negative. It's about minus 197 million TTM, which gives you a negative EPS of around minus 39 cents.
So that's the core problem then, translating that top-line growth into actual profit.
It is. And that negative bottom line is tied directly to their cash burn, the negative free cash flow.
Which, for our listeners, is the money they have left after paying for everything, operations, new factories, R&D.
Exactly. And FCF was negative 116 million last year.
Yeah.
And over the last 12 months, it's sitting at about negative 220 million.
Wow.
And almost all of that cash is being poured into one single project, developing the heavy neutron rocket and building out the factories to handle all those SDA satellites. They are burning cash on purpose to build for the future.
That's an aggressive burn rate. And I have to ask, doesn't putting all your chips on one project, on Neutron, create a massive risk? I mean, if Neutron gets delayed or costs way more than they thought, doesn't that 8-year cash runway you mentioned just shrink?
That's a very fair point. The runway is strong, which helps with any short-term panic. They have over $1 billion in liquidity and a net cash position of 190 million. But yes, you're right. The long-term story is definitely exposed to execution risk.
So a delay could force them to raise more money?
It could. Or slow things down. It's a real risk.
And speaking of raising capital, they just proposed a $750 million stock offering, which makes sense, but it means shareholders are funding that R&D. Let's talk about the high valuation and that dilution.
The valuation is definitely up there. It's trading at about 45 times sales, which is, extremely steep.
Very steep.
But while that $750 million offering is needed for Neutron, they've been careful about the dilution. Across all their shares, it only dilutes existing shareholders by about 3.3%.
Which is pretty efficient. They're not constantly going back to the well.
Yeah.
But to be fully balanced, we do have to mention the mixed signals from insiders.
Correct. We have to note that the CEO, Peter Beck, has sold over 1.5 million shares. Now, we can't speculate on why. It could be for anything.
Personal liquidity, taxes, anything.
Right. But it is a data point. It's a non-bullish signal from a key insider that you have to factor into the risk profile.
Okay, let's switch gears to market context. The stock had a phenomenal run-up last year. What's the recent price action telling us now?
It's showing really strong consolidation, which I think suggests underlying conviction. We had that massive 175% surge in 2025.
Right.
But then it was followed by a pretty natural, healthy pullback, a bit of profit taking over the holidays. It dropped about 8.5% down to the $70 range. But the critical thing is that key support level between $68 and $70 is holding firm.
Which can be an attractive entry point for people looking long-term?
It can be, yes. A retest of support after a breakout.
And what about the technical indicators? Are we seeing big players selling off, or are they buying?
It's definitely an accumulation phase. The stock's trading above its key moving averages, and importantly, we saw what's called a golden cross.
A golden cross, that's just a technical signal that suggests a big shift in momentum, right?
Exactly. It's when the short-term trend, the 50-day average, crosses above the long-term 200-day average.
Yeah.
The 50-day is at $55, the 200-day is at $49. It's a classic bullish indicator that tells you institutional money is accumulating, not selling.
So who is buying? Who are these institutions?
Well, institutional ownership is very high, almost 72%. And we've seen clear cluster buying. Institutions like TB Alternative Assets bought almost $25 million worth. Swedbank AB added over $22 million. So the smart money is clearly offsetting that insider selling. They're buying into the defense pivot.
And have the analysts on Wall Street caught up to that pivot?
Oh, they've fully validated it. The consensus right now is a moderate buy. And after that SBA contract was announced, we saw a lot of target raises.
Yeah.
Needham bumped their target to $90. Key Corp raised theirs to $75. They all get it now. This isn't a launch gamble anymore. It's a real defense system supplier.
Okay, so this is the crucial part for anyone tracking the stock, the catalyst calendar. What are the big events coming up that could really move the needle here?
The single biggest one, the one that affects the entire long-term story, is the neutron timeline. We have to watch its development milestones like a hawk.
And what's the official timeline?
The first launch is slated for Q1 2026. Though, we should always build in some cushion for space sector risks. Some think it could slip a bit to mid-2026. But the key financial milestone is profitability, which is completely tied to neutron scaling up. And that's currently estimated for Q3 2027.
2027. That confirms this is definitely a patience trade. What about closer in? The next earnings report has to be a big focus.
It will be. It's scheduled for around February 26th, 2026 for the Q4 results. The market is going to be watching three things like a laser.
Which are?
First, can they keep revenue growth above that 30% mark? Second, do the margins expand into that 37–39% range they guided for? And third, any updates on how quickly that huge defense backlog is turning into cold, hard cash?
Got it. And finally, what about macro tailwinds? This is a high beta stock, so it moves with the market.
It's very high beta at 2.21, so volatility is just part of the deal. It benefits a lot from any sector rotation into space and defense, especially with geopolitical tensions.
So good news for the defense budget is good news for them.
Exactly. And there's always speculation. There's some unconfirmed chatter about a potential expansion of that SDA deal, maybe pushing it past $1 billion total.
So let's pull this all together. It really sounds like Rocket Lab's high valuation is based on its proven growth and that very smart strategic shift into defense. The vertical integration and that huge SDA contract are essential because they de-risk the whole thing, especially the big spend on Neutron.
That is the core of it. They've changed the narrative. It's not a speculative launch company anymore. It's a diversified space systems defense contractor with an $816 million anchor contract that de-risks so much of the future. They have the runway, they have the contracts, and the margins are expanding like crazy.
Which brings us to the final thought for you, the listener. We know the short-term volatility and the insider selling are baked into the price after this pullback. We know 45 times sales is a high price to pay. So the question isn't just whether Neutron will launch on time. The real question is this: can the company maintain the speed and agility of a small disruptor while also taking on the slow, deliberate, capital-intensive pace of a prime defense contractor? That tension is what will define their success.
And the market, for now, is betting they can manage both.
That's it for this week's analysis. If you enjoyed this conversation and learned something new, please subscribe to the podcast to ensure you don't miss our next breakdown. We will see you next time.